According to the Federal Reserve's own survey of consumer finances, approximately 40% of American adults cannot cover a $400 emergency expense without borrowing money or selling something. That is not 40% of low-income Americans. That is 40% of all American adults, including people who own homes, people with college degrees, people who by every external measure appear financially stable. According to the Bureau of Economic Analysis, the U.S. personal savings rate stood at 2.9% as of February 2025. In April 2020, at the peak of pandemic-era stimulus, that same rate hit 33%. A savings rate of 2.9% means the average American household is currently saving less than 3 cents out of every dollar earned. That figure is lower than it was before the 2008 financial crisis, and lower than at any point in the 2000s. According to multiple surveys from the Federal Reserve and Pew Research, a significant majority of American households do not have sufficient liquid savings to absorb 3 months of unexpected expenses without taking on debt, cutting essential spending, or falling behind on existing obligations. Not a recession, not a market crash. 3 months of real life without a financial cushion. This video presents the institutional data behind a structural pattern, visible in 3 separate documented historical cases, that is currently active in the United States right now. Every figure cited in this analysis comes from a named institution with a named publication. The pattern follows 4 documented stages, and what makes each one dangerous is that every stage feels manageable while it is happening. The first stage is dilution, a gradual, largely invisible erosion of the coverage people believe they have. Between 2019 and 2024, the average health insurance deductible for an employer-sponsored plan rose from $600 to $2,800, according to KFF's Employer Health Benefit Survey. That is a 75% increase in out-of-pocket exposure before insurance coverage activates at all. In 2000, approximately 62% of American workers had a defined benefit pension plan, according to Bureau of Labor Statistics historical data. By 2024, that figure had fallen to approximately 15%. The gap was supposed to be filled by personal savings and 401k accounts. For a majority of households, it never was. The second stage is dependency. As institutional coverage thins, individuals lean on remaining programs more heavily, reducing their own private backup systems. The third stage is disruption, a trigger event that does not need to be catastrophic to be damaging because the buffer that would have absorbed a moderate shock has already been depleted. The fourth stage is disappearance. The safety net is not removed in a single dramatic announcement. It disappears when someone reaches for it in an emergency and discovers that the coverage has conditions they did not know about, limits they did not anticipate, and processing timelines that outlast the crisis itself. All 4 of these stages are currently active simultaneously in the United States. 3 documented historical cases establish that this pattern is not theoretical. The first is the 1996 U.S. welfare reform. The Personal Responsibility and Work Opportunity Reconciliation Act, signed by President Clinton, restructured the fundamental architecture of federal assistance. Before 1996, the federal government operated under an open-ended commitment. If more families needed help, more federal funds flowed automatically. After 1996, states received fixed block grants, the same dollar amount regardless of how many families needed assistance. The risk transfer was structural and documented in the congressional record. By 2002, the number of families in poverty receiving cash assistance had fallen by approximately 60%. Not because 60% fewer families were in poverty, because 60% fewer qualified under the restructured eligibility rules. When the 2008 financial crisis arrived, the hollowed-out system caught far fewer households than historical precedent suggested it would. The safety net millions of families had counted on for decades was no longer operating at the scale they had assumed. The second case is the United Kingdom between 2010 and 2019. Following the 2008 global financial crisis, the Cameron government introduced universal credit, a unified benefit system that merged 6 separate programs into one, presented as a modernization. The rollout took years. During the transition period, millions of claimants experienced gaps of 5 to 6 weeks with no income at all while the system processed their applications. The Trussell Trust, the UK's largest food bank network, reported a 62% increase in emergency food parcels, distributed in areas where universal credit had been fully rolled out compared to areas still on the old system. The number of food banks in the United Kingdom rose from approximately 60 in 2010 to more than 2,000 by 2017, according to Trussell Trust data. A roughly 30-fold increase in less than a decade. The households most severely affected were not the unemployed. They were working people with jobs and a single disruption, a medical bill, a job change, who found that the safety net operated on a 5-week processing delay that real emergencies do not respect. The third case is Japan following the 1990 asset bubble collapse. Japan in the 1980s had no formal government social safety net comparable to Western economies because corporate lifetime employment functioned as that net, providing housing, healthcare, and retirement security through the employer relationship. When the asset bubble burst, corporations quietly shifted new workers to non-regular employment, part-time, contract, and temporary positions, without the benefits that permanent employment carried. According to OECD data, the proportion of Japanese workers in non-regular employment doubled from under 15% in 1990 to approximately 30% by 2003. The safety net did not disappear for workers who already had it. It disappeared for everyone entering the workforce afterward. By the early 2000s, Japan had developed what became known as the working poor, full-time workers who could not afford stable housing in a country that had effectively no visible poverty 15 years earlier. The critical insight from all three cases is the same. Households kept planning their financial lives around a safety net that had been quietly restructured beneath them. By the time the reality became undeniable, an entire generation had already made irreversible decisions based on assumptions that were no longer accurate. Here is the current institutional data, sourced specifically, that maps to each stage of the pattern. On dilution, according to KFF data from late 2024, approximately 48% of Americans under 65 are covered by employer-sponsored health insurance. But employer-sponsored coverage has been restructuring its own risk transfer for 15 consecutive years. Higher deductibles, narrower provider networks, higher premium contributions from employees. The Consumer Financial Protection Bureau released a report in January 2025 confirming that medical debt is the leading cause of personal bankruptcy in the United States, not student loans, not mortgage defaults. Medical expenses from a system that nearly half the country believes they are insured against. On dependency and disruption, SNAP, the Supplemental Nutrition Assistance Program, served approximately 42 million Americans as of January 2025, according to USDA data. Simultaneously, Congressional Budget Office projections published in March 2025 showed proposed SNAP funding reductions of up to $230 billion over 10 years, actively moving through committee consideration. The program feeding the largest number of Americans in its history is simultaneously facing its largest proposed funding reduction. On the student loan dimension, the Department of Education confirmed that full student loan collections resumed in 2024 after a multi-year pandemic pause. Approximately 10 million borrowers who had not been making payments are now subject to wage garnishment, tax refund seizure, and benefit offset enforcement. For a significant number of households, this represents $100 to $400 per month that was not in their existing budget calculations. On Medicaid, during the COVID-19 public health emergency, states were prohibited from removing people from Medicaid enrollment. When that protection ended in 2023, states began conducting eligibility reviews. According to KFF Health News, tracking through early 2025, approximately 22 million people had been disenrolled from Medicaid since the unwinding began. Some lost coverage because their income had increased. Millions lost it due to administrative processing, incorrect addresses on file, missed paperwork deadlines, backlogs in state review systems. 22 million people removed from health coverage is not a rounding error in any economic model. On credit and carrying costs, the Federal Reserve's rate environment since 2022 has created the highest carrying costs on variable rate debt in over 15 years. For approximately 140 million Americans carrying credit card balances, the average interest rate as of Q1 2025 was approximately 21%, according to Federal Reserve data. Every month without rate normalization is another month of compounding pressure on household cash flows that are already operating at a 2.9% savings rate. The three objections to this analysis that arise most frequently each deserve a direct response from the data. The first objection is that warnings like this are always issued and the collapse never arrives. The distinction matters. This analysis is not describing a forecasted collapse event. It is describing a structural erosion that is already producing measurable damage in individual households right now. The 40% of adults who cannot cover a $400 emergency without borrowing are not waiting for a crash. They are already operating inside the disappearance stage. The question being examined here is whether the structural conditions will extend that reality to a larger share of households over the 2025 to 2026 period. The second objection is that the government will expand support when conditions worsen, as it has done historically. The historical record supports that pattern, but the critical variable is timing. During the 2008 financial crisis, government intervention was substantial, but arrived 6 to 18 months after the acute period of maximum household distress. For the households that experienced bankruptcy, foreclosure, and family disruption during that interval, the eventual intervention did not reverse the damage that had already occurred. The current legislative direction in early 2025 involves simultaneous proposed reductions across SNAP, Medicaid, housing assistance, and student loan programs, moving in the opposite direction from expansion. The third objection is that personal financial circumstances vary, and this analysis may not apply universally. That is accurate, and the appropriate response is a specific audit rather than a dismissal. When did you last verify what your health insurance actually covers versus what you assume it covers based on your current plan documents? 5 specific actions are identified by financial resilience researchers as directly responsive to the structural pressures described in this analysis. The first is a written safety net audit, not a mental estimate, but a documented review of 3 specific items: the actual deductible and out-of-pocket maximum in your current health insurance plan documents, the status of any government programs you are currently enrolled in or theoretically eligible for, and your actual liquid cash savings figure available within 48 hours without penalty. If you cannot answer all 3 from current documents rather than memory, that gap is the starting point. The second is extending emergency savings targets from the traditional 3 months to 12 months. The Urban Institute's research on middle-class financial recovery found that families who fall out of financial stability during a recession take an average of 11 years to return to their previous level, if they recover at all. In a labor market where disruption timelines may require 12 to 18 months of retraining or repositioning, 3 months of savings is not a safety net. It is a short runway. The third is building redundancy into the safety net itself, not relying on a single institutional layer. The consistent finding from all 3 historical cases examined in this analysis, the 1996 U.S. reform, the UK universal credit transition, Japan's post-bubble employment shift, is that single point of failure safety nets fail when the single point is under pressure. A credit union emergency loan arrangement established before it is needed, a mutual support agreement with family, a secondary income stream that can be activated quickly, or a professional association with hardship provisions, each represent an additional layer. The goal is not to replace institutional coverage, but to ensure that a gap or delay in one layer does not immediately produce a crisis. The fourth is monitoring specific policy developments directly affecting household finances in the 2025 to 2026 period. The outcomes of congressional reconciliation negotiations affecting SNAP and Medicaid funding, Federal Reserve rate decisions affecting variable rate debt carrying costs, and any student loan program modifications affecting the approximately 22% of households with federal loan obligations all have direct and measurable impacts on household financial resilience. None of these require professional expertise to monitor. They require awareness that the conditions underlying your financial assumptions are not static. The fifth is recalibrating financial planning assumptions to reflect current institutional conditions rather than conditions from 2 to 5 years ago. The savings rate data, the deductible data, the Medicaid enrollment data, and the credit card rate data all point to the same conclusion. The gap between what American households assume their safety net provides and what it currently provides has been widening for years. The households that will be least affected by that gap are the ones that close it through audit and preparation rather than discovering it at the moment of an emergency.